Think big. Think positive. Never show any sign of weakness. Always go for the throat. Buy low, sell high. Fear, that's the other guy's problem. Nothing you have ever experienced can prepare you for the unbridled carnage you're about to witness. Right. Super Bowl, the World Series, they don't know what pressure is. In this building, it's either kill or be killed. You make no friends in the pits and you take no prisoners. 1 minute, you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
Hello and welcome to the StoneX Grains and Oilseeds podcast. I'm your host, Craig Turner. I'm a broker here at StoneX. I focus on the grain and oilseed markets. If you have any questions for me, you can always reach out. My number here on the trade desk is 312-706-7610. You can email me at craig.turner@stonex.com. You can follow me on Twitter at corn, wheat, soy. If you want to sign up for our webinar, which we're going to be talking about a little bit today, it's going to be the day after the election. Just go to www.grainsandoilseeds.com. You can sign up for the webinar series there. We're going to be talking about how we're using South American weather rallies to increase old crop sales prices and hedge a new crop risk. Because it is the day after the election, we'll be talking about that too. Hopefully there'll be a kind of a decisive winner. If not, we'll probably talk just about, what it means for the markets going forward. But I think I think we will have a pretty good idea of who the president is the next day, and we'll go from there. So yeah, definitely sign up if you haven't already. If you've already signed up for the webinar series that we've had throughout 2024, you are part of this. You'll get an email. If not, just go to that website. All the information, my contact info and the webinar info is in the show notes. All right, let's dive into it here. Let's start off with the macro markets. So listen, I'm recording this, it's October 28th. We've got the election is a week from tomorrow. And usually what happens every 4 years when you get one of these presidential elections, what happens is you have kind of a holding pattern in the markets here. And that's what we've been seeing. That's what we've been seeing too. There is odds on right now. It's small odds, but they are odds that Trump could win. You never know on election day, as we all know. You can't with polls and how things go out. But for the moment, the market's trying to price that in. I think what they're doing here is they're probably comfortable with him being along the stock market, and I think we're seeing that in the market here. I also think in the ag markets, we're seeing a little bit more bearish pressure on soybeans. Now, last time Trump was president, 2018, he announced those tariffs, and then we had the retaliatory tariffs from China, and that really it was a pretty bad year in the grain and oilseed markets, 2018. No one wants to see a repeat of that. So, and that's and we're going to get to that. We're going to get to that a little bit. We're also going to get to that in the webinar too. But just in terms of the macro markets, let's just talk. I'm going to take a couple of minutes here, just talk about the stock and equities and the energy markets. On the stock side, there's no reason to believe why we should crash. The economy is doing just fine. And unemployment is okay. The Fed is taking interest rates down a little bit. The Fed and the current administration has been able to get inflation down, right? Where now we're not going back to lower prices, but at least the rate of inflation is coming down to where it's about 2 to 3%, which is where the Federal Reserve wants to be. There's nothing they can do about the inflation of 21, especially 22 into 23. That's unfortunately can't put the genie back in the bottle after that point, but they can slow down the rate of inflation. I think that's what we're seeing now. So it should be steady as she goes. We will see. On the energy side, crude oil is down $4 today. What's interesting, Israel had a lot of, basically over the weekend, targeted a lot of Iran's. They had Iranian targets. However, they had more to do with Hamas than anything else. And it looks like they left the energy infrastructure completely alone in Iran. So there was really just, it seemed like, targets in Iran where Israel had knowledge of where there was Hamas operations. So the reason why we're down $4 today in crude, all last week, the speculation was when Israel does attack Iran, they're going to hit some of the energy assets, right? And they didn't. So no energy infrastructure was damaged, or at least that I haven't seen any reports of it. And so crude's down $4. By the way, when crude oil is down $4, very difficult for the grain and oil seeds to rally. You got that energy component on the corn ethanol side. You got the energy component on the soybean oil. So for the oil seed side, and then you throw that all together, wheat has a tough time, which was up a little bit for a while there and was fighting, counter to the soybeans, the canola, and the soy and the corn, but they couldn't hold on there. So it's not a we're down a little bit. The USDA will release their reports after the close here on harvest progress. We're expecting corn to be around 80%, soybeans to be 90%, and all this harvest pressure is probably wrapping up. So from a macro side, it's steady as she goes. I think it's unrealistic to expect a major move between now and the election. For a major move to happen, you have to have a lot of money flow. And I just don't see how the money flow from the money managers really goes either way between now and next Tuesday. So that's where we are. We're kind of in a holding pattern, and that'd be for the commodity markets and for the equity markets here too. All right, so that's our macro view. Let's talk about grains and oil seeds. We are having a webinar. It's gonna be next Wednesday, day after the election. It's gonna be centered around using South American weather markets and how we can use that to either increase our old crop sales or make hedges for new crop. As an added little bonus, we're gonna throw in some election analysis too, depending on what happens Tuesday. So that'll be a little bit real time going on there, which my compliance department's probably gonna, you know, feel the test there. I might, you know what I'm gonna have to do? I'm gonna probably have to get 2 sets of slides approved beforehand, based on what happens on the election on Tuesday. So a little double work there, but it's going to be good. It'll be interesting. So I'm looking forward to it. Um, let's start with corn here. So let me bring if you're watching on YouTube, I'm going to bring up a chart of continuous corn. If you're not watching on YouTube, the links will be in the chat. So here we go. I'm looking at a chart of corn. I'm looking at a continuous chart of corn going back to the about a year here, and we can see. I'm sorry, going back 2 years here, and we can see basically corn bottoming out since, let's just say, January, of this $4 to the low side to high fours to the upside. And to me, that makes a lot of sense. When you have adequate to burdensomely supplied markets, we should go back to a trading range, like an old trading range. Now you may say, hey, Craig, the old trading range was not $4 to 480, going back from 2007 to 2019. And you're right, it wasn't. That old trading range was more of a 350 to 420 trading range. But you got to add on that 20% inflation. So now that trading range, in my mind, is $4 to 525. We haven't really gone to that $5, since August of last year, right? For front month corn. But there are things that are happening that could get us there later on this year, or I should say early into 2025, which I think you can use this time now to try to set ourselves up for it. But when I take a look at the balance sheets for corn, and I'm going to bring up my corn balance sheet here on my computer screen, we're going to be about a 2 billion carryout on corn as of the last WASI. When I think about next year, if we're at 90 million acres again and a 182 yield, we use as much as we produce. So we're about 2 billion. But if we have lower acres, which is definitely a possibility between the dryness and the low price, and we are below cost of production like this, which we are, tend to get 89, somewhere between 88 and 90 million acres. And let's say the dryness is an issue and we don't have a bumper crop like we did this year. You usually don't have 2 record crops year over year. What if we're just at a 178, or if the market just even thinks we're at a 178? Like, we could have stress during the spring and summer. Market thinks we're at 178, or could be, and then we get the rains to go back to 180 or whatever it may be. 178 yield and 88.5, 88.5 million acres planted means ending stocks are 1.4, and we're below 10% stock to usage. And by the way, that's not even. I mean, that could mean in the high. I mean, that could be $5, $6 corn, on the spikes on the high. When you're thinking about, is the market concerned about, are we going to be under 10% stock to usage or not? And if you take a look at the major exporters, we are tight. We'll get more into the major exporter scenario and why we're actually tend to be quite bullish on corn and wheat with any kind of real production issues in South America, United States, lower, any kind of increase in demand or lower production next year. We are setting up for a supportive environment for corn going forward and for wheat. Beans are a little bit tougher, right? Actually, and even canola. Canola. The problem with canola is you got this back, you know, backdrop of a very big soybean crop coming out of South America and too many soybeans in the United States and poor demand from China, and that does weigh on canola a little bit. But the fundamentals and the supply and demand for corn, wheat, and canola are all improving, and we'll be going more to that in depth. But the whole point here is, I think when I go back to this chart of December corn, I don't see the reason to live below $4 for any length of time. In my mind, $4 today is 330 corn of 2018, 2019 at a 2 billion carryout in October with demand being okay and nothing really to write home about. 330, 340 corn back then in the front months would have been fine by me, which means we should be somewhere between $4 and 420 now. And that's where we are. And you got to ask yourself, what's October 28th? What are the potential cards that could come out of the deck in the grain and oilseeds? Is it lower or is it higher? I would say the first greatest chance, we just kind of chop around here for a little while. But after that, if something was going to happen to move the markets either way, it's much more likely to be bullish at this point. Whether it be South American weather issue, could certainly happen anytime. It was dry to beginning of the season, and then they got the rains. Anyone who's been around the block a couple of times in the grain and oilseed side knows how hot and dry things can get very fast, right? And put weather premium into the market, or how a couple of very big sales can come into the expert market and start changing the outlook of the market. So, in my mind, corn, you either want to be neutral or you want to be bullish. And we're going to be going over that more next week on specific strategies. And I've been writing about it in my newsletter, and if we're having conversations about it, if you're a client here, happy to go over it with you. And with corn, you could be long futures and buy some puts, and the puts are relatively inexpensive compared to the past few years here for corn. Or you can do collars. And honestly, if you're a believer like me in the 20% inflation, $4 corn of today is 330 of 5-6 years ago. You can collars collars to try to take advantage of the upside. I think are very interesting this time around. So that's where I am on the corn market, and that's gonna. I don't see why things change between now, a whole lot between now and the webinar and the election that we have next week. Now on the wheat market, I'm gonna go to Chicago wheat here on my chart. We take a look at wheat, and we've been bottoming in the front month at this 520 a couple of times in Chicago wheat. So 520 in my mind is around 440 from December, from 2018, 2019. So those are some pretty low prices for wheat. In my mind, wheat used to be like a high four, low five market before all this inflation. So I really expect, to me, when wheat gets below 550 in Chicago, that's a pretty strong value area, I think, going forward, with potential highs on just regular weather markets being $7. Wheat used to be more of a 450 to $6 market. I really do think it's getting closer to like a 540, 550, all the way to $7 market. And that's how we're going to trade it, this year too. Now, what's interesting about wheat, the United States does have a lot of wheat. Let me get my balance sheet here going. So I'm taking a look at my balance sheet. And at 47, let's say we have 46 million acres planted next year. Oh, let's say we harvest 82%, which I think historically is pretty close. So we'll take 46 million acres and we'll times it by 0.82, abandonment and all that. So that gives us a harvested area of about 37.7. Trendline yield should be around 50, I would think. And all right, so that puts our ending stocks maybe down around 725. If we have 47 million acres of wheat planted, your ending stocks are about 750. So I do think year over year we come down on wheat a little bit here, based on current estimates of using plant 46 to 47 million acres would be very similar to last year, and having a 50 yield is going to be pretty close, I think, to where the trend line will be for the ag form. So we draw down a little bit, but not a lot. I will say this though, when you look at the major exporters, they are coming down. We're going to go into this in depth in the webinar next week, but you're going to see how since 2021 we have not been able to fully recoup the production that was lost from the Black Sea War, and how, unlike all the other major grain and oilseed markets, wheat gets tighter and tighter every year. And we could see eventually some kind of tipping point here, and the tipping point is going to be when demand comes back to the United States in a big way. So that is, I'd want now. The thing is, it's a show me market. The wheat. I've been saying this for a while. Wheat is a show me market. It will not rally until you start to see demand come back into the United States. But I think it happened now, whether it be the fourth quarter of this year or the first quarter next year, sometime between now and May, it looks like we're getting tighter. Russia could be under 10% stocks usage. And when they get under 10% stocks usage in their wheat market, not only do the domestic prices really start to increase and they have their own price inflation, you start seeing Russia doing um, their their export quotas, right, raising minimal price floors, all these things that they'd like to do to slow down basically the exporting of wheat. Because usually the way a lot of the Russian grain firms, they just want the market share and they want to get it all out of the country as soon as possible, which to me makes sense because if you're in a country like Russia with their economic system, uh, one in the hand's worth two in the bush, and you're probably trying to sell everything as much as possible before the government gets involved. I mean, I honestly I can't blame them. So that's what they're usually doing. That's why the pace out of Russia and the price is usually the way it is. Meanwhile, when you're like Ukraine or European Union or the United States, Australia, because those are more free market uh, countries and exporters, there isn't this rush by the private exporters to get everything out, entering the register as fast as possible. So little insight there. So we'll see what happens with wheat, but I still like the wheat market. I just think it's going to take a little bit of a longer time to develop. If I'm a farmer, whether I'm a corn farmer or a wheat farmer, I actually like, if you got to sell here, I like buying back on the board with some kind of courage call strategy or reownership strategy. I guess with a call on the reownership strategy. And if you have stuff in storage that you need to sell, I do like the courage call strategies that we've been talking about too, or a courage collar, depending on your how you feel about risk. Um, right, so that's the wheat market. Hasn't My opinion really hasn't changed here on it. Let's go to soybeans. Okay, so here's the problem with the soybean market. At 87 million acres and around a 53 yield, we're at 550 million ending stocks. Now, if we have 87 million acres again, which is what the baseline is for the USDA, which doesn't mean a whole lot, but at 87 million acres and a trend line yield, we're going from 550 to 640. We're adding 100 million bushels almost. So that's not great for soybeans, especially with the 165 million metric tons that could be coming out of Brazil alone. So that's a problem. Now, in years where we're this far below cost of production on the soybean market, and this is for land that, let's say, is rented in a very high productivity area, let's call it, Illinois or Iowa, you usually do not see 87 million acres of soybeans. You see closer to 83 to 85. If we're at 85 million acres and a 52 yield, which I think is where we is a possibility, we basically use as much as we produce. So that's an interesting stat. 85 million acres and a 52 and a half yield, which would be trend line. That's our kind of our even line. That's our line where we use as much as we produce, which is always something to keep in mind when we're talking about pricing. If we get down to 83 million acres, which when soybeans are this, below the cost of production nationally versus, when you factor in land rents, and you get a 50 yield, which wouldn't be out of the question, being a couple bushels below if we have a tough season next year. I think stocks would be 200. So it's not the end of the world for soybeans. It's not that we can't rally again, but it does take more. It doesn't take a whole lot for wheat and corn to get tight, because not only are the US stocks not that far from being tight, but the global stocks are also tight. So corn and wheat have more potential to run. Soybeans can. It's just that these are bigger moves in the production cycle for soybeans to really get going. Corn and wheat need less of an issue. Beans need a much bigger issue to get to this kind of scenario. So with that said, let's take a look at the soybean chart here. I'm going to bring a continuous chart of front month beans. 960, we see this low from August and then again during harvest. Listen, 960 soybeans today is $8 soybeans of 2018, 2019. So back then, if we were talking about a 550 million carryout, potential to be 600 million, and a massive crop coming from South America, and beans are $8, high sevens, low eights, I'd be like, yeah, that makes sense to me, especially for this time of year. I think that's what we're seeing here. I think we're seeing the old soybeans used to trade between 860 and $11 for most of the marketing year, and really only break out above $11 if we thought we were going to be getting tight stocks again, under 300 million bushels, being batty under 7% stock to usage, the 200 handle, that kind of stuff. And which really be below 6% stock to usage. But, that is what would get us beans into the teens. And as you just saw, to get beans in the teens, that kind of ending stocks number, we got to be 83 million acres and a 50 yield. It's a lot to ask for off the bat. Not impossible, but a lot to offer. So the real range in my mind then is this $10, the old 860 to 11 is really, let's say 10 to 13. Now, could we be, in years where 860 didn't hold, we went down to the low eights? Those were years like 2018, right? Years where China lost half their hog and there was no meal demand, where we had the Trump-China tariff wars. But as long as it wasn't something like that, the lows would be around 860. So I do think we have this. Here we are, 960 is a low. I would expect us to eventually pop up in the 10 range. You can make a run to $12 in a weather market. I don't think that would be unheard of. That would be kind of like the old 11. And the only time we never really ran much above $10 was that 2018 year, where just the shock and awe of the tariff war really crushed the soybean market. But other than that, we always made some kind of run close to 11, even in the years where we had some pretty large stock numbers. So I would think at some point, you do get a weather market. I guess there's always the possibility that the world has garden-like growing conditions uh, between now and harvest, and there's always that chance, but I think it's unlikely, and I do think you get at least one weather market a year, if not two, that we'll be trying to set ourselves up for. I can't get that excited though about beans, because there's just more work that needs to be done, but it can happen. It can happen. I think demand's an issue. Now, one thing we'll just talk about, two things to look forward. We're going to talk about this more in the webinar too. Acres for 2025 in the United States are going to come into a big way, and how they, basically, if you look at, we're going to look at the historical numbers of when depending on profitability per acre, how do the acres usually fall between corn, wheat, and soybeans? So that's going to be an interesting discussion. And then and then the last thing I'm just going to touch up on here, and we'll be talking about next week too, is the election. Now, if Harris wins, it's probably just a lot of more of the same, I'm guessing. I don't think a whole lot changes, which would make sense. I mean, I don't see I don't see how the Harris administration would be much different than the Biden administration. Could be wrong about that, but it's just kind of the way it seems. If we get a Trump administration, I think three things happen. One, I wouldn't be surprised if one of the things that comes out of this is if used cooking oil from China, yeah, somehow finds its way as the odd man out on the renewable fuels biodiesel. That wouldn't shock me. If it were doing America first, and it's about the American farmer, and we're now starting this new era of renewable biodiesel for soybean oil and canola, I have a feeling the used cooking oil from China component finds its way out of the formula. We'll see. That is just my guess, knowing how things went from 2016 to 2020 with the Trump administration. That kind of move would make a lot of sense. We'll see. You never know. He hasn't said anything about that. I would think there's a huge thing going on or debate. Do we go back to, if Trump's the president, do we go back to the trade war, and we got to start thinking about 2018 and how all the prices tanked because of the tariffs. But a lot of those tariffs are still in place, and China has moved on from the United States, and we now can calculate like what it means for. I mean, China's already doing more of their business with Brazil and Ukraine if they can do that first before they do it with the United States. So all that stuff's already priced in, and not a whole lot of it's going to change. I mean, there will be some implications. What's going to be interesting is, are we going to have this transition of, when Trump presidency ended, we were coming at, we only phase one got done. Do they try to pick up where they left off with phase two on the commodity and the agricultural side? He hasn't really said anything about that, but you would think he would want to just pick up where he left off. It's interesting because you don't have an administration. It's rare. I mean, when's the last time someone lost and then, was president lost and came back? Um, so who knows? But I would think we'd be going more onto the phase two side. We'll get much more in depth on that next week. And I also think it's why, just a little sneak peek here, if I'm China, like, I'm not buying anything from the United States right now. Like, you want to see what happens in this election, because if if Trump wins, you now got to come back to the negotiating table on trade again. You're going to want to have your buys for soybeans and corn and wheat, whatever it is, in your back pocket. Like, you wouldn't do it now. You would wait to see what happens. And then if Harris wins, just go about your business normally. And if Trump wins, then you're saving up all these buys as a bargaining chip going forward, like they did during phase one negotiations, which was like textbook for them. And then finally, and we'll get a little bit into this a little bit again next week, but I do think something's going to happen in livestock if Trump is reelected. I think there's a lot of regulations and a lot of red tape, and you've been hearing Elon talk about it, and you've been hearing Trump talk about it. He talked about it on Rogan, and he was just talking about how there's a lot of regulations that hamper production in the United States. And I wouldn't be surprised if they took a look at the livestock market and just how tough it is for guys, in the ranching business, cow calf operations, feedlots, whatever it may be, um, and maybe take a second look at some of these things, because they're going to see the high price of beef, and the animals aren't coming online as people thought, and there's a lot of different reasons for it. But one of them is regulations. I wouldn't be surprised if we looked at that, and that'd be very interesting too. So those are just kind of my thoughts. We'll get more in depth of it next week. I am looking forward to the webinar. Election should be exciting, right? No matter who wins here. And yeah, if you have any questions for me, you want to go over anything I went in this podcast, feel free to reach out. I think we're hitting value areas, and listen, Actually, one more thing I want to go over, canola. So what's interesting about canola here, all right. So what's interesting about canola here is we had these lows at 540, and for anyone looking at the chart here, this is priced in tons, and it's also in Canadian dollars, right? That's how canola is priced. So for our friends up in Canada, and for those of you who don't know, Western Canada, you know, their canola is like corn for the Midwest here. It is primarily the big cash crop. And listen, the funds went short. Funds were record short 150,000 contracts of canola just a month ago. And now they're only short about 60,000. So that's a huge, going from 150,000 short to 60,000 short is a big move in the canola market. And you can see canola, this chart, has gone from 540 per ton to 625 per ton. Canola is probably a $550 to $700 per ton market now in a normal trading range. What's interesting here is the production numbers for canola. Like Canada has it at what, 19 million metric tons, and most analysts have them at 17, 18 million metric tons. That brings the carryout, instead of being over 3 million metric tons, to under 2. And for those of you listening that don't really understand what I'm talking about here is, that means we're going from potentially over 15% stock to usage for canola down to under 10% stock to usage for canola. So all of a sudden, with the lower production estimates, canola is going from an adequate to burdensome market to an adequate to tight market. So that is interesting too. So, and also Canada is by far the largest producer and exporter of canola throughout the world. So very interesting. There's reasons to be neutral to bullish on corn, wheat, and canola. I wish I could say the same for soybeans, but I will be very interested to see what the Trump administration thinks about livestock and regulations, and also use cooking oil for renewable biofuels here in the United States. And that could be very supportive for soybeans and soybean meal before you know it. So anyways, www.grainsandoilseeds.com. That is the webinar. We're going to be going through all this next Wednesday, South American weather markets. And I got a little double work for myself. I got to prepare 2 sets of slides depending on what happens Tuesday night. But it's going to be fun. I'm looking forward to it. I hope you can make it. And good luck, everyone. If you need something, give me a call, shoot me an email, follow me on Twitter. Otherwise, I will see you next week.
This material is conveyed as a solicitation for entering into a derivatives transaction. This material has been prepared by a Daniels trading broker who provides research, market commentary, and trade recommendations as part of his or her solicitation for accounts and solicitation for trades. Daniels Trading, its principals, brokers, and employees may trade in derivatives for their own accounts or for the accounts of others. Due to various factors such as risk tolerance, margin requirements, trading objectives, short-term versus long-term strategies, technical versus fundamental market analysis, and other factors, such trading may result in the initiation or liquidation of positions that are different from or contrary to the opinions and recommendations contained therein. Past performance is not necessarily indicative of future performance. The risk of loss in trading futures contracts or commodity options can be substantial, and therefore investors should understand the risks involved in taking leveraged positions and must assume responsibility for the risks associated with such investments and for their results. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure accessed at www.danielstrading.com. Daniels Trading is not affiliated with, nor does it endorse any trading system, newsletter, or similar service. Daniels Trading does not guarantee or verify any performance claims made by such systems or services.